Welcome back to XRP Update, the channel where we break down the biggest XRP developments, institutional moves, and global crypto infrastructure. Today, we need to have a serious, unfiltered conversation about what just unfolded over the last 7 days, because this past week was arguably one of the most structurally important stretches of time XRP has seen in its entire history. While the vast majority of retail traders were glued to their screens, panicking over short-term price candles, drawing lines on charts, and stressing over whether a support level would hold, something absolutely massive was happening in the background. Major financial institutions, sovereign regulators, and central bank-connected entities across 5 distinct global jurisdictions quietly moved deeper into the XRP ecosystem. Think about the sheer scale of that for a second. We are talking about 5 completely different financial jurisdictions making major structural moves involving XRP Ledger infrastructure in a single 7-day window. In New York, the parent company of the New York Stock Exchange filed a massive product launch alongside OKX. Across the Atlantic in the United Kingdom, the Bank of England brought Ripple directly into high-level policy discussions regarding the future framework of digital assets. Down in Australia, the Reserve Bank dropped a final report confirming they successfully settled tokenized government treasury instruments using RLUSD and the XRP Ledger. Over in Singapore, Franklin Templeton expanded its real-world asset tokenization activity on the XRPL, while local regulators approved digital asset distribution tied to the exact same ecosystem. And yet, if you look at the price chart, XRP barely blinked. That massive, glaring disconnect is exactly what we need to unpack today. The retail market is obsessing over hourly and daily candles, letting emotion dictate their every move, while global institutions are playing a completely different game. They are playing the long game, quietly building out the next generation of global settlement architecture. One of the biggest misunderstandings in the entire crypto space right now is the assumption that price action always reflects real-world adoption in real time. It doesn't. If you look back at the history of traditional finance and technological shifts, infrastructure is always built quietly, in the dark, away from the public glare. Only years later does the broader market look back, connect the dots, and realize what was actually happening underneath the surface. This past week is highly likely to be one of those historical inflection points. The underlying architecture moved at a lightning pace, while the chart stood completely still. That is the real story. While social media was aggressively debating whether XRP could hold its support level around $1.30, the actual systems tied to global trading, settlement, tokenization, and cross-border finance were relentlessly advancing across New York, London, Singapore, and Australia. When you see that level of synchronization across multiple global financial jurisdictions in a single week, you have to understand that it is not a coincidence. This isn't a collection of random, isolated announcements or speculative rumors. It means the underlying infrastructure of the XRP Ledger and its ecosystem has reached a level of maturity where major conservative players finally feel comfortable moving at the exact same time. The average retail chart reacts daily, and market emotions shift by the hour. But institutions? They position themselves quarterly or over multi-year macroeconomic cycles. Let's start by breaking down what happened in New York, because a lot of people completely miss the deeper structural signal here. Intercontinental Exchange, the owner of the New York Stock Exchange, partnered with OKX for a regulatory filing involving perpetual futures tied to traditional oil markets. Most of the mainstream headlines just focused on the trading product itself, discussing how commodity markets are shifting to digital platforms. But you have to look at the settlement layer underneath the hood. OKX has already integrated RLUSD and XRP infrastructure deeply into its ecosystem. This means the filing effectively positions RLUSD as a core settlement stablecoin and collateral mechanism, while XRP functions as the liquidity bridge for these tokenized commodity flows. Perpetual futures are no longer some small, experimental corner of crypto. Platforms like Hyperliquid have already proven there are billions of dollars in daily trading demand. Institutional players are entering this space because the demand is already massive, and tokenized finance is becoming impossible to ignore. The key takeaway is that XRP Ledger infrastructure is quietly positioning itself right beneath next-generation commodity settlement. What makes this even more fascinating is the synchronization. At the exact same moment Wall Street infrastructure was moving, Ripple was sitting at a high-level roundtable in the United Kingdom with Innovate Finance, sovereign regulators, and major financial firms. They weren't there to pitch a product or hand out business cards. They were actively participating in drafting the rules for Britain's future digital asset framework before the country's broader regulatory rollout arrives in the coming years. When a government or a central bank adjacent entity invites a private company to help shape policy, that company stops being just a vendor or an outside market participant. They become part of the actual foundation. Ripple was brought to that table because they have spent years building operational, compliant cross-border settlement systems at scale, and regulators want to study those real-world frameworks instead of just relying on abstract theories. Given London's massive concentration of capital and fintech talent, having XRP infrastructure woven into these policy discussions makes it incredibly hard for critics to dismiss it as merely speculative technology. If we shift our focus over to Singapore, the story gets even more compelling. Franklin Templeton's Benji tokenization platform connected with the XRP Ledger for asset activity in Asia, backed by massive regional banking giants like DBS. The Monetary Authority of Singapore is widely recognized as one of the most stringent and sophisticated digital asset regulators on the planet. They do not tolerate reckless experimentation or compliance shortcuts. Their implicit and explicit oversight of this integration is a massive stamp of institutional legitimacy. It proves that when we talk about the XRPL today, we aren't just talking about retail peer-to-peer transfers anymore. We are talking about how tokenized real-world assets, regulated stablecoins, and liquidity routing systems operate together inside a highly secure financial ecosystem. But the single biggest mic drop moment of the entire week came from Australia. The Reserve Bank of Australia, working alongside Ripple, Chainlink Labs, and ZeroCap, officially completed Project Acacia. They released a comprehensive final report confirming the successful 24/7 settlement of tokenized government treasury instruments using RLUSD and the XRP Ledger. Let that sink in for a moment. A central bank of a G20 nation didn't just announce a vague partnership or a theoretical pilot for the future. They published a final report proving that they successfully settled government-backed debt and treasury instruments on XRP-connected infrastructure in real time. While the retail market was bickering over minor price fluctuations, a major central bank literally rewired the plumbing of government finance and proved that it works flawlessly. While people on social media look for quick wins and overnight spikes, the actual data shows that this infrastructure is accelerating at an unprecedented pace. Look at the numbers. Visa's on-chain analytics dashboard recently revealed that RLUSD transaction activity is approaching massive monthly settlement figures, with activity on the XRP ledger accelerating rapidly alongside Ethereum. This isn't a hypothetical projection. These are live, observable transaction mechanics. On top of that, Ripple recently backed Squid Router to enable native-to-native cross-chain transfers within the Axelar ecosystem. For the less technical folks, this is a massive deal because it means assets can move between networks like Ethereum, Solana, and the XRPL without relying on wrapped tokens. Wrapped tokens have historically been a massive security risk and a source of friction in DeFi. By enabling direct native interoperability, the XRP ecosystem lowers the barrier for liquidity movement and developer integration globally. Even the institutional capital flows are telling a story. While Bitcoin-related investment funds saw notable outflows this past week, XRP investment products actually bucked the trend and attracted positive institutional inflows. The big money is shifting quietly. For the longtime XRP holders who survived the grueling multi-year SEC lawsuit and the endless waves of FUD, this entire setup probably feels strangely familiar. During the height of that legal battle, the mainstream narrative was that the institutional thesis for XRP was completely dead, that US banks would never touch it, and that the project was finished. Yet, behind the scenes, Ripple simply put their heads down and kept building on a global scale. When the court rulings finally came down confirming that XRP itself is not inherently a security, It fundamentally shifted the legal landscape in the United States. But even after that massive victory, the price action remained largely disconnected from the institutional progress. That disconnect has frustrated a lot of people, but it has also become a defining characteristic of this market. The infrastructure and the regulation move relentlessly in one direction, while the retail chart tells a completely different story. The scope of what is being built extends far beyond simple cross-border payments. The tokenization of real-world assets is widely considered by Wall Street firms to be a multi-trillion-dollar opportunity over the next decade. It involves taking traditional financial instruments, like corporate bonds, real estate, treasury bills, and private equity funds, and putting them onto programmable digital ledgers. The fact that the XRP Ledger is actively climbing the ranks in real-world asset tokenization and embedding itself into frameworks managed by firms like Franklin Templeton, Ondo, and Guggenheim means it is positioning itself at the absolute center of this transition. We are looking at a future where the XRPL handles treasury management, tokenized fund distribution, liquidity routing, and collateral management on a global scale. This is a massive leap from the early days of crypto. To add another layer to this, Ripple's recent inclusion in prominent global disruptor rankings alongside massive AI and retail tech giants shows how the institutional perception has evolved. The financial world no longer looks at Ripple as just another speculative crypto startup experimenting in a garage. They view it as a foundational fintech infrastructure provider. Once the narrative shifts from, "Will this technology survive?" to "How do we integrate this safely, compliantly, and efficiently into our existing systems," the trajectory of the entire ecosystem changes forever. That transition doesn't happen in a single day, and it certainly doesn't reflect in an hourly trading chart, but it is the most reliable indicator of long-term survival and dominance. When you step back, tune out the daily noise, and look at all these puzzle pieces together, the broader pattern becomes impossible to ignore. You have New York financial giants positioning products over XRP-related settlement layers. You have the UK government bringing Ripple into policy-level discussions. You have the Central Bank of Australia confirming successful government treasury settlement on the XRPL. You have Singapore advancing strict, regulated tokenization frameworks, and you have institutional capital quietly rotating into XRP products while stablecoin transaction volumes accelerate. Yet, despite all of this monumental structural progress, the retail market spent the week gripped by fear, uncertainty, and doubt because the price chart was testing support levels. That contrast tells you everything you need to know about where we are in this current cycle. History consistently shows us that infrastructure eventually wins. Financial systems that have been in place for decades are not torn down and rebuilt overnight. It takes years of testing, regulatory alignment, and technological maturity. But when you get to a point where momentum aligns across multiple continents simultaneously, things can change with incredible speed. The synchronization we witnessed this week is the ultimate signal. 5 jurisdictions moving on related infrastructure within a 7-day window is not a random coincidence. It is clear evidence that the ecosystem has matured to a point where institutional actors feel entirely comfortable executing their plans. As always, nothing discussed today is financial advice. Every single investor out there has different financial goals, different risk tolerances, and completely different investment timelines. You have to do your own research and make decisions that align with your personal situation. But looking at this strictly from a structural macroeconomic perspective, this past week provided one of the clearest examples we have ever seen of the massive divergence between short-term retail emotion and long-term institutional adoption. The chart may look uncertain or stagnant to someone trying to make a quick trade today, but the architecture underneath continues to expand relentlessly across borders, central banks, and regulatory bodies. For those who understand the value of financial plumbing, that is the only story that truly matters. This is XRP Update. Stay informed, stay patient, and stay positive. We will see you in the next one.